All right, good afternoon, everybody. Thank you for joining today's Trends in Philanthropy webinar. Today's program will be presented by Eric Haluska and Jim Decker, partners with Withum's not-for-profit niche, and Daniel Mayo, principal at Withum. We also have with us Jordan Jones and Travis Childers, business development with not-profit insurance services, and Rebecca Reynolds Russell, vice president with JP Morgan Chase. Before we begin, I have a few housekeeping notes. At the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content will be addressed throughout the course of the webinar. Also, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I would like to introduce our first speakers, Jordan Jones and Travis Childers with Nonprofit Insurance Services. Their group specializes in the social service industry by way of insurance placement and insurance programs developed for nonprofits. Take it away, Jordan and Travis.
Hey, thank you, Ashley. I appreciate it. First of all, I'm Jordan Jones, and we have our business development director, Travis Childers, on the line as well. First of all, thank you guys for having us. Insurance is a very important topic right now, especially in the nonprofit space. There's been a lot of day-to-day developments that are changing rapidly, and we want to go over a few things. First of all, the workers' compensation developments for your nonprofits, potential loss outcomes due to this COVID crisis, most importantly, the future of the insurance market, and how does that impact you guys, and how does that impact your nonprofit? Well, that's easy. Budgeting. If claims start going out of control due to this COVID crisis, and et cetera, pricing will go up, et cetera. So Travis, if you want to go ahead and take the lead on this, on the future, on the worker comp developments, go ahead.
Yeah, definitely. I'll address that, and then other lines of insurance, and then just kind of close it with, again, what you mentioned. What does it mean? Current state of the market. Because of COVID, work comp carriers, they've been very, very timid in writing a lot of new business, and it has to do with healthcare related facilities. We do about 260 or so nonprofits throughout the state of Florida. It equates to right now about 55 million in premium. We have some of that healthcare already on the books, and we have more than a dozen or so pandemic cases that are definitely applying for workers' comp. The Florida Office Insurance Regulation, the guys up there in Tallahassee did April the 6th give us guidance that first responders and also the healthcare folks are definitely going to get a presumption, or they're definitely going to get the coverage with no questions asked on that side. So that'll apply to a lot of the police, first responders, folks in the hospitals, skilled nursing, federally qualified health centers that we have within our nonprofit book on that side. So we're just kind of patiently awaiting to see how that will affect us. General liability and professional. I mean, this is something not necessarily due to the pandemic, but we've seen a lot of increases over the past couple of years just due to the social inflation. We have, cases that have been tried for several years ago at $1 million. These days, because we have a lot of younger folks on the jury, on the trials, are awarding higher determinations there. So we're seeing increases there. Property, this one kind of correlates back to the COVID. You're probably hearing President Trump and some of the other federal regulators, trying to push a lot of the property carriers to potentially include business income in the COVID, because you have a lot of restaurants and other mainstream businesses that just are not essential at this time, and they're forced to close down. Difference maker is currently there's the bad news is on business income and business interruption, a lot of the pandemic and viruses is excluded because there's no coverage trigger there. There has to be direct physical loss to the building or the properties for that coverage to step up and pay. So that's something we're just kind of patiently awaiting. I would imagine at some point they'll give us guidance if we are or not going to pay on that side. But again, because of the COVID, the presumption is already in place for those first responders and healthcare workers. But in the end, if the property carriers are forced to pay the business income, and then I've already mentioned the work comp carriers are very, very timid, and we got a dozen cases on our side. We assume that it's going to get a lot worse on that. What does it mean overall for y'all? It's going to mean tightening the market. Market right? Obviously, there's going to be less insurers available to offer, you know, lines of coverages for the nonprofits that are out there. And when anytime that happens, you know, it's going to limit the market, it's going to limit your options. And then also, anytime that they're forced to pay, you know, there's a good case out in California right now to where the governor's push work comp carriers, for example, to make, if you were working in the front line and you contracted COVID, they're going to make that primary, make the workers' comp carriers pay, even though you may or may not be in the healthcare industry, or you may not be a first responder. So these are things going to force work comp carriers into paying, and anytime that happens on that side, it's going to translate into higher premiums and could potentially disrupt, you know, your budgets on that side. Some other things that we're noticing on the umbrella side, excess above your primary coverage. Umbrella market's getting very, very tough as well. We're seeing premiums on the rise, and a lot of, historically within our programs, we've been able to offer 10 million limits on umbrella. Well, this year, in the past couple of years, those have been scaled back, and this is guidance from our excess and reinsurers back to the 5 million mark. Is about as much as we can get on that. So we're seeing a lot of strategy with our consultants and our agents, where, you know, now this is what you're paying currently now for your insurance products. We kind of ease that back into a budget premium, and then, you know, what can we get you coverage wise for that current pricing that you have in place right now. So there's just going to be a lot of strategy play. You know, profits and your agents and your brokers and your consultants to meet your coverage expectations and your budget expectations on your premium levels this year and the next couple of years looking forward on that side. So that's kind of current state of the market. It's definitely going to impact property and work comp for sure on that side. So if you haven't looked in a while, I'll just kind of close it with, you know, if you haven't entertained another quote in a while, give Jordan a chance. I know that he's probably reached out to most of y'all already, but as you come up to a summer renewal, I know a lot of you folks renew on 7/1s that are out there. Give Jordan a call, give me a call, and we'll see if we can help you through this challenging times. So with that, I'll turn it back over to Jordan.
Travis, you there? Oh, okay. Yeah, Travis, I appreciate that. Thank you for going over the state of the market for us. We did have one question from a nonprofit, and it's that they're starting their budget for next year early, and that's good. You know, what percentage increases are we looking at for insurance wise? And we're looking at, you know, since the market is hardening, we're looking at the 15 to 25% increases across the board in the standard market. Now, with that said, our group obviously specializes in nonprofits, and what we do is we are partner and develop programs specifically to address the high increases that the standard market does. So one of those products is the Florida Insurance Trust, and what that is it's a program designed for nonprofits just like you, 501c3s. And what that is that's a program able to combine all your lines of coverage, whether it's property, your work comp, your auto, your general liability, your D&O, your EPLI, etc., into this program. And it allows us to leverage those lines in a group purchasing effort and keep those 15, 25, 35% increases down to, let's say, 5, 10%. So again, if you feel like, you know, you might be hit with a big increase, or you got a claim situation that's getting out of control, you know, give us a call. We do have you know, nonprofit markets and our own programs that we develop that specifically address enhancing coverages and keeping those increases down. And then, you know, at the end of the day, when you're looking at your budget, you're able to use that money that you save with our programs and put it right back into the mission for your organizations. Eric, if you have any questions for us, I saw one come in about the budgeting, but I'm not sure if you have any more that might have come in.
Nothing's come in yet. As attendees, you know, come up with some thoughts, if you throw them through the chat box, we'll make sure we can circle back around and address them. Okay, perfect. And obviously my cell phone, if you want, we can send that out, and you can give me a call, and obviously just pick my brain and feel free. We can send that out.
Great. Next up, we will hear from Rebecca Reynolds Russell. Rebecca serves as Vice President Senior Relationship Manager for JP Morgan Chase's Government and Not-for-Profit Banking Group. In her role, Rebecca brings 20+ years of experience in municipal, not-for-profit, and corporate finance for entities. Rebecca has vast experience in relationship management, debt financing, operational cash flow analysis, investment management, capital markets, and treasury management. Take it away.
Thank you. I'm trying to present my screen, so bear with me in the technical difficulties of sharing bandwidth with 4 children in homeschool right now. Try to see here. Can anybody tell me what you can see on the screen?
You see your talking points, Rebecca.
Okay, good. All right, so let me start. Can you see the graph?
In the presenter mode.
Yes, graphs are good.
Okay, thank you. Okay, good. Well, good afternoon. Go ahead. Did you have something to tell me?
Yeah, flip back to the graphs. You had them before. They were up. Perfect.
Okay, well then bear with me because I gotta switch screens with my talking points. So minor details, I am fired on the slide front. Okay. Anyways, as everybody's well aware, JP Morgan Chase Bank is in the height of the payroll protection, program, and I know that many of you have, are working with your bank on the payroll protection program. I am struggling with my slides, so I'm just gonna stop presenting and we'll just talk and call it a day. So you can go ahead and pull my screen down because I can't get it to work. But anyways, what I wanted to talk to you guys about today really from a banking perspective is fraud prevention. I think during a time like this, there are certainly, quite a few, fraud attempts that are happening to many of our customers. Fraudsters in this type of environment where there's a heavy crisis situation, they look for opportunities like this to target your organizations. And so I really wanted to spend a few minutes today focusing on fraud prevention and talking about some tips and tools that you all can use with your current bank to help reduce that risk. So in one of the slides I was going to show you, it was going to show you that about 71% of organizations under $1 billion in annual revenue have actually experienced some sort of fraud attempt. So the point in that is, as we all know, it's very prevalent in our society. The fraudsters seem to be finding new opportunities on a daily basis to come after the financial assets of your organization. So I wanted to tell a little story actually that happened about a week ago. A customer contacted me in the morning and said that overnight there was, they got a phone call from the FedEx guy's about to ring the doorbell. Okay. Said that they got an email or a phone call from what they thought was Chase. And the lady on the phone said, "Hi, this is Linda from the Chase Fraud Department, and we would like to confirm some recent activity on your account in order to prevent possible difficulties using your account. It is important that you call us at your earliest convenience at this number." So, of course, my customer was concerned. They called the number back. It was an automated system. The system asked for their tax ID number, which they entered, and then the system asked for their account number, which they also entered. And so then the system said, "Thank you, we have no recent activity for you to review," and hung up. So concerned, the customer called me and said, "Can you check Chase? Is this fraudulent?" And so the point was, it was not Chase calling them, it was a fraudster acting like their bank, trying to get this information. So one thing I think that's important is that most banks, I know JP Morgan Chase, We will never call you and ask you to verify your account number or your tax ID number or disclose any highly sensitive information via the phone. Like most banks, we will ask, some security verification questions, but we will never ask you to disclose information like your account number, your social security number, or tax ID. Nonprofit organizations tend to be at a higher risk for fraud attempts, mainly because your Form 990s are published on the internet. Your Form 990s, as you know, contain a wealth of information on your organization, your tax ID number, the names of your executives, and lots of information that fraudsters can use to try to trick you into providing other sensitive information. This information, of course, coupled with the information they can pull off your website, like email addresses and phone numbers, personal details from executive team biographies. This is what fraudsters use in order to attempt fraud on your organization, whether it be through an email attempt or, a phone call like I shared the example of. These are ways that fraudsters use information that you've provided to the public to support your mission to try to attempt fraud on your organization. So real quick, I'm going to talk about a couple tools that your bank probably offers today if you're not already using them, which I hope you are. A couple different fraud prevention tools. One is called Positive Pay and the other is called ACH Debit Block. So let's talk about Positive Pay first. As you know, paper checks contain your bank routing and account number at the bottom of each check. Positive Pay is a fraud prevention service for the paper checks that you send to your employees and your vendors. Basically, you register every check that gets cut with the bank by providing the bank with the check number and the dollar amount of that check, and sometimes even the payee name. And once your bank has that information, they will not pay or process any checks presented on your account unless the check number, dollar amount, and payee name match the information that you provided the bank for that specific check. This prevents fraudulent checks from clearing your account, which is very important. I want to give you some examples of why Positive Pay works, because these are a couple of fraudster examples that I've actually seen with my customers over the years. One is called check washing. Fraudsters will steal a check from somebody's mailbox. Then they'll use a solution to basically wash the payee name and the dollar amount of the check off of the check. Then they write in whoever they want to make the check out to and whatever dollar amount they want. They go and cash that check. If there's nothing at the bank that prevents them from cashing that check, they've just committed fraud and stolen your money. Another way that Positive Pay can help, prevent fraud is when the fraudsters will steal your account information, and they'll go to a check ordering service of some sort or print them off their computer, and they'll make fake checks with your routing and account numbers on the bottom of that check. And then they'll send that check out, and pay people through your account. Another quick story, a few years ago, one of my clients had their check information stolen and printed on fake checks. The fraudsters were purchasing goods and sending checks, these fraudulent checks, to these people for paying for these items. By the time that my clients got to their end of the month bank reconciliation and noticed there were many checks processed for which they had no invoices, the fraudsters were long gone with the items that they purchased, and my client was now having to deal with the loss of those funds. Positive Pay would have caught these checks before they were processed. The second fraud prevention product that I want to talk about is ACH Debit Block. So in addition to the paper payments that you send out to your vendors and employees, it's also likely that you send out ACH payments, which are electronic payments. And since Positive Pay only protects against fraudulent paper checks, we also recommend that you use ACH Debit Block to protect against unauthorized ACH payments. it's probably likely that you allow some vendors to auto debit your account for payments like your monthly credit card, your insurance premiums, your payroll service, retirement benefits, merchant services. There's lots, that you could allow because you've authorized those payments. Well, these vendors can do this because you've provided them with your bank routing and account information. ACH Debit Block is a service that creates a filter to only allow ACH debit from vendors that you pre-specify, like your insurance and payroll and what have you. And then it blocks all other ACH debit attempts. Why is this important? Okay, so have you ever gone online to pay a bill, like a credit card, a utility bill, a cell phone bill, and one of the payment options is to enter your bank routing and account numbers to make that payment via ACH? Well, when fraudsters steal your account information, they can sell it on the dark web, and since ACH payments are electronic, they can quickly initiate fraudulent transactions worldwide with your account information. So by adding ACH Debit Block to your accounts at your bank, you can prevent fraudulent ACH transactions. So, fraudsters and scammers are constantly evolving. As a banking industry, we are constantly coming up with new products and services to help minimize the impact of financial fraud. But we do encourage you to contact your bank and ask them to assist you with their fraud prevention tools and services. Because especially during a crisis time, unfortunately, the fraudsters are looking to take advantage of people living in, fear and uncertainty. So please reach out to your banker, reach out to your bank, and tell them you want to make sure that you have all of your fraud prevention tools in place. That rounds out my session, and I will turn it back to you, Ashley.
Great. Thank you, Rebecca. We now welcome Daniel Mayo and Eric Haluska. Eric Haluska is a partner at Withum and serves the firm's assurance and accounting service area, specializing in the not-for-profit industry. Under this capacity, he advises clients on operational efficiencies, audits, reviews, and not-for-profit tax compliance. Daniel Mayo is a principal and national leader, federal tax policy at Withum, with more than 20 years of professional tax experience, as well as experience in federal, international, and product taxation. He has been a leading voice and author for Withum's COVID-19 Resource Center, providing tax updates related to federal government policy addressing this pandemic. Welcome, Dan and Eric.
Thank you.
Yes. Good morning. Thank you, Ashley. We're also going to welcome Jim Decker, who's also a partner at the firm and our not-for-profit services niche leader. So he's going to assist with some of the questions. When we originally sent this invite out a few weeks ago, we were having discussions on how to make it best useful to the audience. And what came out of that discussion was soliciting questions from the attendees up front to see if we could help answer what was really bothering, the community out there. And so with that in mind, we're going to start with some of the questions that were addressed, that were sent in initially, and some more questions that came in later on a few days ago. And then as the live questions, if you have any, feel free to ask, and we'll address those time permitting. So with that being said, the first question coming from one of the attendees was, as a recipient of federal grants, which covers some or all of our certain staff salaries, what is the official word on whether those funds can be included when applying for forgiveness of a loan under the PPP, Paycheck Protection Program? We have anecdotally heard that federally funded salaries must be repaid. What is the official SBA position? So while we haven't heard specifically from the SBA how they, attempt to apply their guidance to, the not-for-profit world and federally funding grants, we are overwhelmingly advising our clients not to double dip. For anybody in the not-for-profit sector getting federal funding, we know double dipping is not good and simply, frowned upon. With that being said, including, some of those salaries up front in and of itself is not necessarily a bad thing when you're considering the maximum loan amount to reach. However, it could create some issues on the back end when you're looking at forgiveness, because you're ultimately not going to want to use those funds on that group of people that are getting federally, getting reimbursed. However, in addition to that, in some of the other guidance in the CARES Act, there was plenty of funding to the medical sector, and specifically under the HHS funding requirements, they mentioned several instances that any funds that are obligated or will be refunded by other sources, whether federal or not federal, are required to be repaid. With that in mind, that kind of hints that, keeps you back on the stay away from double dipping. But, using them in the front may not create an issue. Try to stay away from it. Second question, how does the PPP grant get accounted for in the books, especially if not all is forgiven and not knowing what the forgiven amount will be in advance of any approval? Again, I don't think it ultimately is difficult in concept. I think ultimately we're advising our clients to treat this as a standard loan. Initially, the loan itself is not forgiven, and you can't guarantee that it will be forgiven on the back end. So typical accounting, debit, cash, credit, debt, and so on and so forth. As you incur the expenses, account for those normally. And I assume, we'll get some guidance on the back end on how to treat the debt forgiveness, whether that's going to be a reduction of the expense or really a debt forgiveness, revenue line item. That's to be determined. But, at the end of the day, the bottom line won't be impacted, and it's really just geography and presentation on the financial statements.
Yeah, Eric, I've heard informally that it's going to be they're thinking about making it would be income for book purposes, but not for tax purposes, since it's tax free. So it'll give rise to a permanent difference.
Great.
Yeah.
All right. So that question had two sub questions. Also, will further information be coming on how to obtain PPP loan forgiveness? And I'll turn this over to Dan, one of our experts in the SBA team.
Yeah, so we expect there to be significant guidance on the loan forgiveness question. This is the number one question on everybody's mind, and this is what everybody is asking about these days. So with them, we've written a few different articles on the topic. One is a general article walking through the general rules of forgiveness. Two is an article on the forgiveness uncertainties and what are the areas of confusion and what guidance do we still need from the SBA. And third is whether taxpayers should segregate the proceeds in a separate account and the benefits of doing so. Also, when you look online, there's many calculators at law firms, and I haven't seen an accounting firm one yet, but some law firms have provided calculators. We haven't seen one that we agree with yet. We've seen many, I'll call them crude versions. Again, I'm not criticizing the people who put them out there. Just I don't think they were not intended to be comprehensive in their starting points, and so I think there may be perfect ones out there. I just haven't seen them. We're working on our own calculator. We were not releasing it though, just to give a sense. We want our product to be right, and so we've chosen not to release it until we get additional guidance, given there's so many areas of uncertainty. Again, and which are pointed out in one of those articles I mentioned on the Withum website.
Okay.
By the way, I heard that guidance would be coming in the next 2 days, is what someone said informally. I don't know if that's true, but someone did indicate we should have guidance within 2 days. I expect, my own personal view is, if not 2 days, within the next week or two, because this is an important topic and businesses need to plan how they're going to manage and pay their expenses for the next 8 weeks if they're already in the middle of that process. And to issue guidance at the end of that period would be very unfair and unhelpful to many of the companies that have already obtained the PPP loan.
Okay, and there's a follow-up there. If we are accepted for the PPP and keep our employees employed at the pre-COVID salaries, how long is that in effect so not to jeopardize forgiveness? I.e., if we still need to make salary cuts in July, can that be done without jeopardizing forgiveness?
So the answer is yes. The law requires that salaries be paid during the 8-week period, but there's no requirement that employees be continued beyond that date. So there's no requirement that businesses continue to pay their employees beyond that date. I mean, that's the expectation of the law, but it's not a requirement. So they certainly can pay them during the 8-week period, even if they don't believe they will have the ability to continue those employees after the fact. And we need to remember that's consistent with the statute, because the goal of the statute was to keep people off the unemployment rolls and to prevent, the 20+ million that are already on the rolls from swelling to 50 million, which you easily would have had they not put this law in place. So the goal of this is to bring employees back if they've been let go, to bring them back, put them on the company's payroll, and to continue that for at least 8 weeks. Whether this program's extended is unclear. Certainly, there's no indications that it will be at this time, but I have to see how the economy goes in the next few weeks.
All right, thanks, Dan.
Sure.
Somewhat more focused on the not-for-profit sector. For those that receive the PPP funds, are we getting board approval to accept the loan? Jim.
What we've been doing is telling our clients to look at the bylaws. Obviously, every organization has the bylaws, which determines how they should be managing the organization. I would say most of our clients have some requirement where there's any kind of debt, they need to get approval of either the board or a authorized committee of the organization. And what you have to remember here is that these loans may not all be forgiven, so you actually are entering into debt. So our recommendation to our clients has been to definitely get some type of approval. From sitting on the other side, I'm also the chairman of an organization that received one of these loans. And the way we handled it is that we went to our executive committee and went over basically the terms, how it was calculated, and what would need to be done to be forgiven over time, and got approval before we entered into the agreement. So I would recommend that you reach out to at least a finance executive committee, if not the full board.
Thanks. Dan, how to follow up on applications submitted or even receive acknowledgement of submittal of the same? I know, the answer last week, if we asked this question, is a little different than the answer now, but give us some guidance on what we're advising.
Sure. So it's not clear whether people who are in the queue for the first round of funding will continue to be in the queue for the second round of funding. We believe that's the case. And we believe that the SBA, I think they indicated they have a couple 100,000 applications left over from the first round. And we've also heard from banks that they're starting their own queues, and they are going to approve applications and submit them to the to the SBA in one batch. So they were able to, essentially press a button and submit hundreds or thousands of applications at one time. So we are recommending that people submit their applications now, make sure that they're fully documented and that there are no problems with it, and they try and reach out to the bank and make sure it's approved. Some banks are telling people their application's been approved prior to submitting it to the SBA. Others are not. Others are just approving it and submitting it without telling them. And some others come back with questions and concerns. But we are recommending that people quickly get in there, because this funding that's expected to be approved today or tomorrow is likely to be exhausted within the first few hours of the process opening up, just given the backlog of applications and the number of people who are expecting round two who did not get in round one. A related question we get oftentimes is, should I apply to more than one bank? The answer is yes, you can apply to more than one bank, but you can only take one loan. So if in fact you do apply to more than one bank, just make sure you don't sign 2 loan applications. That would be fraudulent. But there's certainly nothing wrong with applying to 2 banks, and whoever submits you first will get you the loan. The hope is that one of them will get you through. But we have a lot of clients who are submitting to 2 banks, some more than 2.
Yeah, and I think, Dan, you can confirm this. What we're hearing from the new wave is there's going to be a little more focus on the state and local community banks versus the big top tier banks for the funding. Is that what you're hearing as well? Yes,
they're trying to reserve some of the applications and funds for the smaller banks to prevent, again, the large banks from just batch processing tens or hundreds of thousands of applications. Just some stats. I think they had 1.6 million loans were approved in the first round for the 350 billion. And the ranging from 10 million to some extremely small ones. The SBA does publish these statistics if you're interested. They're on the web. They produce a number of loans by state, by industry, and the amount of loans and the average amount per loan.
Okay, so there's a question that popped up on the live chat that kind of relates to the question I'm going to ask now. So we'll hit it back to back. So Dan, the impact on 501c6 organizations, and potential, we know that they're not eligible for the PPP, and unfortunately that's an unfortunate situation and probably an oversight in original drafting. But what other options are out there aside from the PPP that organizations, 501c6s, 501c4s, or even other organizations that didn't get the PPP or weren't eligible? Where they seek funding?
Yeah, the SBA has other lending programs out there. There's the EIDL, the EIDL loan, the Economic Injury Disaster Loan, EIDL. That funding has also been exhausted. They're about to replenish it with the new legislation. There's also the Main Street Lending Program is another program that's been announced but not opened up yet. And that I believe that's open to 501cs. Also, in the event they don't get the loan, the PPP, they can apply for employee retention tax credits, which we'll get to later on. I did hear a rumor, I don't know if it's true, someone asked me today, but I haven't seen the bill, that they were thinking of expanding the list of 501cs for the new legislation. And someone said C4s might be included. I don't know. I haven't seen that. I haven't heard any or seen anything in the press about that. So it might just be a total rumor that I'm advancing here, but don't, it is just a rumor. I have no confirmation.
Yeah, and it's funny you mentioned that was the question that just popped up was, have you heard of any forward movement with the new bill of the 501c6s, the 501c4s? I know that we can certainly advise that Congress has certainly heard the gripes and screams from the communities down here that they inadvertently left out every other charitable organization aside from C3s and C19s. So right. We're hoping that the new legislation includes them, but as of now, we just don't have any guidance.
Correct. I haven't seen the bill that passed the Senate either, and the one going to the House. I don't, and I haven't seen anything in the press about it.
Okay. What are the trends government funding after an emergency? Should we expect the Arts Council, state and city support to decrease in the next year? So this is a little, very specific to a type of not-for-profit. And what we thought, it's really impossible to see. What we are seeing is that, the government's already stepped into unprecedented territory, and what they continue to do is we're unsure. We know it's not over, and there's more funding coming down the pipeline. While what's kind of ironic in some other sectors where we're seeing certainly a drop in charitable donations, and in the health sector, we're seeing a drop in elective procedures. But on the same uptick, they're seeing an increase in funding coming down the pipelines through the CARES Act and other acts that are given funding. And there's more grants out there. There's some private foundations that are offering their services. So particularly for the Arts Council, I don't know. It's hard to say what type of federal or state funding decrease you'll see, but you should be aware, monies are being used, every minute for, to keep us out of this crisis. So taking a look at the budget and frankly staying in touch with your grant, your grantor groups and the people you speak to, the representatives at those agencies. They can better advise you. So we have taken the PPP loan. When we applied, we had a head count of 607, an FTE full-time equivalent of 250. Is there a ratio that we need, a ratio of what we need to return to? Is it based on total head count, the FTE number, or the total payroll we had prior to the loan?
Yeah, that's a good question. That brings up the sort of the heart of the forgiveness calculation and the reductions to the forgiveness calculation. And so the way the forgiveness calc works, there is first you add up the amount subject to forgiveness, which is the payroll costs, the rent, utilities, and interest on mortgages. And then from that amount, there are reductions. And the reductions, there's a headcount reduction and a wage reduction, which they operate differently from each other. And then to further complicate it, there's a restoration rule that undoes those reductions if certain employee reductions, headcount or wage reductions are eliminated by June 30th. So they add it up, they drop it down, and they add it back up again. is the way the calculation's designed to work, and then there's a lot of detail in each of those steps. So the loan application called for a number, the 500 or less was required to be put on the loan application, but that was not the FTE determination. And so we just the other day, we saw someone from the SBA speaking. I believe they were out in the western part of the country. I can't remember now. And we think they got this wrong. And they were under the impression that the FTE count was the one listed on the application. We do not believe that's the case. The application called for the total number of employees. So part-timers counted as one person, day laborers counted as one person, and full-time people counted as one. So it was intended to get the maximum number of people for the purposes of determining the 500 person eligibility, or greater if it was based on the NAICS code. In contrast, the FTE concept, or full-time equivalent concept, is what's used for purposes of the headcount reduction rule. And again, the headcount reduction is one of two reductions. There's a headcount and a wage reduction. The briefly sort of to summarize the headcount reduction, they compare the number of FTEs during the base period. So you take the average number of FTEs, full-time equivalents, during the 8-week period, the covered period. That's the period that starts from the day the loan is issued and funded. And then you compare that to one of two periods at the borrower's choice, either the period from mid-February to end of June, or of 2019, or the period of January to February of 2020. And the borrower can pick whichever is most advantageous. There's also a rule for seasonal employees, but I won't address that here. So you compare the average number of FTEs in the 8-week covered period. That's the period they want you to spend the money to get forgiveness. And then you compare that to one of those two base periods. And if there's no FTE reduction, number of FTEs, then there is no reduction under this headcount reduction rule. The complexity comes because the headcount reduction rule doesn't look to the individual employee. And so if you have employees, 1 to 10 in the base period in February to June of 2019, but you have 10 employees in the covered period, the 8-week period after the loan is made, and it's called employees 11 to 20. There are 10 different employees, 10 different people. And so even though under the headcount rule, you had 10 before in the base period, you have 10 now in the covered period, there's no reduction in the number of FTEs, therefore there's no reduction in the headcount rule. But that's only half of the equation, because there's a second rule which looks at wage reductions. And it's not clear in the case of the rehire situation, the one I'm addressing now, where you had 10 employees that are now former employees and you have 10 new employees. And I'm picking this extreme example just to highlight the awkwardness of the calculation. In reality, the company will probably have this 8 of the 10 will be the same employees, and 2 will have quit for one reason or another, or been fired and replaced. So we have a situation where you had 10 in the base period, 10 in the covered period, no reduction under the headcount rule. But what about the wage reduction rule, that separate rule? And that second rule, the wage reduction, looks to the wages that were paid from the covered period to the most recent quarter before the loan was made. And you're allowed to reduce wages by 25% without penalty. And then if you reduce them below 25% or cut them more than 25%, that reduces the loan forgiveness amount. So in that case where you rehired the 10 employees, those original 10 employees went from whatever their wage was to 0, and the new employees went from 0 to their current wage. Well, the wage reduction rule is written one way. It only reduces you for people whose wages went down. And in this case, those 10 employees went down from their current wage to 0. So the first 25% doesn't cause a reduction. They would have a 75% reduction for each employee, because this test, the wage reduction goes on an employee by employee basis. So there would be a wage reduction. So it's not clear if they're going to apply that wage reduction rule after the headcount reduction rule. It doesn't seem fair. It seems punitive to apply the rule twice. My own view is that if you pass the headcount rule, they shouldn't then reapply the wage reduction rule, but it's not written that way. And the statute seems to allow the application of both rules, even in that rehire scenario. And even though the business did everything right by keeping people employed, even though the employees may have left for their own reasons or because they had another job, that these rules potentially could penalize the employer by reducing the amount of forgiveness for actions that are not their own doing. So long story short, it's not clear how these rules are going to be calculated. We expect the guidance that comes out will address these and other issues on how these two rules work: the wage reduction rule, the headcount reduction rule, and then there's the rehire rule, which I'll address briefly since I imagine we'll get questions on this. The rehire rule says that if a company brings an employee back or reinstates their wage by June 30th, 2020, then that the reduction or the headcount or wage reduction will not be considered for purposes of the reduction test. So it says it gives you a chance to fix any sort of past firings or wage reductions. But the application of this rule is also unclear, because what if your 8-week period ends before June 30th? Say it ends June 15th, and then you hire the person back on June 30th. Well, that means there's no reduction then for that person, even though they weren't employed during the 8-week period. That's one of many complexities about the rehire rule. But there is that rule that is intended to undo any harsh effects from the wage and headcount reduction rules. Long answer to a short question, but I knew it was going to come up, so I thought I'd address it all at once.
Yeah, to go off script a little bit, I have a follow-up. You recently sent something out yesterday about this, and you and I talked about the difficulties of rehiring previously laid off employees that may be collecting unemployment now, because the unemployment, they're getting a higher wage than what they maybe were earning. So can you give some guidance on what we're suggesting, especially with the offering the position back, and what that means from unemployment for that individual as far as you as the employer go?
Yeah, so the employer, in an effort to gain maximum forgiveness, will offer the job back to the employee. The employee then has a choice. They either take the job, which is a lower wage for them. If they take the job, they're ineligible for unemployment, need to tell unemployment. Unemployment stops. They go back on the employer's payroll, and they get paid under the PPP funded loan that the employer has. And that's sort of what Congress intended to happen. But because unemployment comp, because of that $600 bump that the federal government gave the states for 13 weeks, is putting many people in a higher wage scenario under unemployment, they're refusing the job. So what does the employer do in that case? The employer the only remedy really is to say to the employee, you've been offered your job, and preferably in writing, you've been offered your job. If you choose not to take it, you still were offered your job at a comparable wage to the one you had before, so you're now ineligible for unemployment anyway. And you need to tell unemployment that you've been offered a job, you refuse to take it, and now you're voluntarily unemployed, which means you're ineligible for unemployment. So that's the employer's remedy, is to sort of play hardball and say, I'm giving you your job back, I want to pay you, I've got a loan to do so, and come back to work. But the remedy, though, if the employee doesn't want to do that, what can the employer say? If the employee says, no, I'm not coming back, the only thing they could do is tell unemployment, call unemployment themselves, or reach out and say, I offered this person a job. If they didn't tell you, I'm telling you that they were offered a job and they're no longer eligible for unemployment. It sort of puts the employer in a bind, because they're not looking to really create hardship for their employees, but they also have this loan, and the intent is to pay employees.
Now, Dan, along those lines, I'm getting a lot of questions from clients saying their employees don't want to come back. And the questions that they're posing to me is, can I hire someone else at a similar rate to replace that person?
Yeah, the answer is yes. Yes, we believe you can, but it's not certain. And that gets into the point of, if you hire someone new, you've solved your FTE problem, because your FTEs in the 8-week period relative to the base period are going to be the same, but it's a different person, and that the wage reduction rule goes by employee. So the old employee's wage went from, call it $50,000 a year, to 0, and the new employee, you don't get credit for the new employee under the wage reduction rule. So if they apply that wage reduction rule in addition to the headcount reduction rule, it'll be punitive in that scenario, which is not the right outcome. So we don't think that's going to be the case, but we have to just keep advising of that possibility until the SBA gives definitive guidance saying that won't be the case. You also get a weird scenario. Some people have, the unions have that same issue, where they hire people from a union, and the union supplies the employee. They don't even have a choice. And so the union may provide different people. And, in the construction area in particular, where that comes up. And that's to say that they have that rehire scenario, 50 times over.
Okay, so we have kind of three questions that are all similar, and they're all going to kind of focus around the 75% rule. So the first question is, any clarity on the PPP forgiveness calculation when payroll costs are lower during the 8-week period than they were in the 2019 period that's going to be, compared to them, coupled with less than 75% of the loan proceeds being spent on payroll during the 8-week period?
Yeah, the 75% rule is an interesting one, because when the SBA first announced it was in their interim final rule number 1, the first one I think was April 2nd. They've since come out with an IFR interim final rule 2. And in the first IFR, it was stated as a forgiveness rule that no more than 25% of the forgiveness amount can be overhead costs. Recall that forgiveness amounts are amounts paid during the 8-week period that are 4 things: payroll, rent, utilities, and interest on mortgages. And what they're saying was 75% of it must be on payroll, which is a goal of the statute to keep people employed, and that only no more than 25% can be overhead. So what are they doing? They're incentivizing employers to spend the money on employees, because the more an employer spends on an employee, the more room, the overhead room they create to put their overhead expenses through and have them paid by the federal government. So if you just think about it big picture, the federal government is really saying to employers, you're going to be the conduit for this money. We're going to give you money. We want you to pay your employees. And in exchange for doing so, the more you pay, the more we will allow your overhead expenses to be forgiven. So almost think of it as they're paying the employer to do the work by paying these employees rather than putting them on unemployment. And so that's sort of what the rule was intended. When you got into IFR 2, they stated the rule, and that came out, I think, mid-April. April 14th is my recollection. But in that rule, they stated it in terms of allowable uses on the loan. They sort of rephrased it as not so much a forgiveness rule, but you must spend 75% of the loan on the payroll costs. And the implication, which was even stated by some banks, which we don't believe to be true, was that if you spend less than 75% on payroll, you got zero forgiveness. And I don't think that's what was intended, but the way the SBA wrote the rule, it's somewhat vague. And there is the other authority for that 75% rule is that many of the loan applications we've seen, not applications, I'm sorry, the loan documents where the bank says, you've gotten your loan, here's your 5-page loan document, sign here, and then you'll get the money. That document itself has a representation where the lender or the borrower promises to spend at least 75% of the loan proceeds on the payroll costs. So again, that's not binding for forgiveness, but that's a rep issue that the borrower makes to the bank, which is a federally backed institution, which means it's fraud and signed under penalties of perjury. So that's sort of how the test evolved and where it is now.
Okay, thanks, Dan. I think that I think that answered a few questions that came through live, as well as the one we had previously. I'm going to move down.
If you want, I can jump ahead. It's related to this. The SBA came out with a new frequently asked question today. I think it was the SBA, it might have been Treasury, but it was a new frequently asked question they added to their list. And it talks about these, they're trying to get at the scenario where like Ruth's Chris and Shake Shack, where they got these large $10 million loans. In the case of Shake Shack, 20 in terms of Ruth's Chris Steakhouse. And they said these are publicly traded companies and they don't need the money. So the new frequently asked question says, can you get the money if you are owned by a large corporation that has access to capital? Is essentially what the question says. And what the answer highlights is that if a borrower has access to other capital, such as a parent through public company, through the public markets, a publicly traded company, it's going to be hard to prove they have a need for this loan and that the loan is necessary, and that they're stressing that representation that was required in the application and on the loan agreement, that current uncertainty makes the loan necessary to support the ongoing operations of the business. And so we just want to highlight to people that the government is very focused on fraud, and they're very focused on these large companies getting these loans that don't really need them. And so they're going to they gave a grace period up until I think it was May 7th to repay the loan. So if a company took a loan, for example, let's say a company has $100,000 monthly payroll, they took a $250,000 loan, but what if they have $5 million on their balance sheet, right? They don't really need the loan. Is it necessary? The government's clearly of the view, when you listen to tweets by Marco Rubio, a senator from Florida, you listen to Secretary Mnuchin talk about it, they're trying to prevent fraud and limit these loans to small businesses. And I think that's what caused the SBA to come out with this question and answer. addressing the situation. So if a company is in that situation, or a non-for-profit's in that situation, and they think it's debatable whether they actually needed the money, there is a grace period. They can pay it back without any they sort of take you off the hook if you pay it back by May 7th. After that, you won't be given that grace period. But it wasn't phrased in terms of a grace period. It's phrased in if the money's paid back, we will deem that rep to be satisfied. So you're essentially saying you're off the hook if you pay it back. So that's out there. If a company, if a not-for-profit is concerned about that, they should speak to their counsel and see if paying it back it makes sense or not.
Do we know at this time if those monies that are repaid back by the bigger organizations are then going to be available for some of those applicants that
be reallocated? I think the SBA said they were going to reallocate the Shake Shack money and the other monies they get back in. So yeah, I think they will be.
Okay. I think this next one is a short answer from you, Dan. But can not-for-profits apply SBA's alternative size standards to apply for the PPP loan?
Yes, there's 3 ways into the PPP program. One is you have under 500 employees, and that's an objective test. 2 is if your NAICS code has an alternative, has a numerical employee standard that is higher than 500, you can have more than 500 employees and still get in. So one NAICS code, for example, has 1,250 employees. A business can have 1,200 employees and still get in under that code, even though they have more than 500. So that's the second way, and that's the alternative size standard that Eric's referring to. And the third way is a small business concern, which they've defined as tangible net worth of less than 15 million and 2 years revenue, most recent 2 years revenue less than 5 million. That's a third way that companies getting tangible book value or tangible net worth, meaning assets minus liabilities minus intangible assets. That's what they mean by tangible net worth.
Thanks. Jim, direct this one to you. Will the PPP loan forgiveness be subject to A-133 audit reporting?
That's a great question. It's a question I'm getting a lot from clients that receive federal funding. As of now, we're not aware of any guidance in this area. I think, though, our thought process is that this will not be subject to the uniform guidance or 133 rules.
Okay. Will nonprofits receiving the PPP loan and having payroll expenses covered under that loan be able to submit those payroll expenses for reimbursement under federal state funding grant? And this is a long question. I think we already answered that. You don't want to be deemed double dipping into federal funding. So I think that answer is pretty easy, but it goes on. If nonprofits cannot double dip, will it come down to a case-by-case basis of each federal and state agency deciding if unused funding rolls forward or is lost? I have nonprofits trying to decide whether or not they should apply, and I'm struggling to answer these questions based on the current guidance. So carving that up and taking out the double dipping sector, what we've heard some agencies discussing. I was on a call last week with for some federally qualified health centers, and HRSA was talking, and they discussed the opportunity to possibly rebudget some of the funds that were designated for that group of people to a later period, or B, maybe reallocating them to different groups of people. So in their case, they have certain, medical providers that are covered by this grant. And what they were saying is, well, you need to reach out to us. You need to talk with us, talk to your agency, and see what options are out there. Now, if that were the case and you were able to extend the budget of that agency or in some way free up those funds so where they're not needed to cover that group of people, then I think you would be able to apply for the PPP loan for that group of people and pay those salaries. Again, you don't want to pay those salaries and then get refunded from the federal government, because then you'll be double dipping. But if your agency was willing to work with you under these conditions and shift some of the terms out a little further or reallocate those funds to different purposes, again, subject to grantor approval and whatnot, then I think you would have the right under the PPP guidance to apply for that loan.
Yeah, and along the lines there, Eric, for nonprofits that's already received the loans and has federal funding, they should be reaching out to their agencies now, because obviously a lot of nonprofits have June year ends. So they're getting to the end of the budget period. So it might take a while to get that budget modification approved. So what you want to do is, if you have the loan and you know you're going to have a reduction in salaries, it would make sense to reach out to your agency, look to get a budget modification, or see if it's something you'll be able to roll over into next year. And for those who are coming to the end of their budget period, you really want to do that now, because I know a number of organizations have received the loan and now they're starting to figure out the forgiveness. So you don't want to wait and for guidance. I think it's a good time now to reach out to these agencies and make sure that you're dealing with it now, because if you wait till the end of June, it might be too late to do anything.
Great. Good suggestion. So I think you answered this again earlier, Dan, but maybe hit on it one more time. We applied for the PPP loan with a large bank, but our application is still pending. Are you suggesting we search for a smaller bank or local bank to apply for?
Well, I wouldn't suggest they do it. I'd say that they wouldn't be out of the norm if they were to do it. I'd say keep the application in, keep your priority with that bank. You know, you want to keep your priority, your spot in line in the queue, and hopefully you'll get approved through that bank. But it wouldn't be unreasonable to submit an additional application to a second bank and try and make sure that you're submitted one way or the other.
Okay. Knowing that some organizations didn't get approved or ineligible, can you re-hit on those opportunities of the the Retention Act, the deferral of payroll taxes or the employee retention credit?
Yep, sure. So there's two other credits available, two tax credits available as part of the CARES Act that are sort of keyed off of the PPP, and then there's general benefits like NOLs and excess business loss and a lot of other things. But the two key ones are the employee retention tax credit and the payroll tax deferral. And so we'll focus on the first one. The employee retention tax credit is a tax credit for 50% of wages up to $10,000 that are paid from March 13th to the end of the year. And so because it's 50% of the first 10,000, it's a $5,000 credit per employee. As you can see, this is not as valuable as the PPP, given that allows you to exclude up to $15,385 per employee in salary. But so the credit is available if you meet one of two. Well, for a not-for-profit, you have to meet one criteria, which is you're fully or partially or fully suspended operations due to a government shutdown. And the IRS applies that rule very liberally. And what the partial shutdown is intended to be the restaurants who they no longer have in-room dining. So they have the takeout, and they have delivery and takeout options, but not in-room dining. So there's significantly reduced revenue. But the way they've defined it, it just says that if there's a government shutdown that what's the language they use? If there's a government shutdown that limits commerce, travel, or group meetings, and that as a result of that, you're not able to continue your operations at their normal capacity. So it's a very broad definition, which allows a lot of room for companies to get in and not-for-profits. But what we're recommending is that people document their entitlement, do some kind of memo explaining how they're affected by this, whether the limitation on travel means they can't do their mission, or whatever it means for them and their operations. The payroll the employee retention tax credit is not available if you obtain a loan under the PPP, so that you can't do both. It's one or the other. What's not addressed is, can a company take the employee retention tax credit while they're waiting to hear from their lender about the PPP loan? That's not been addressed. That was addressed in the second benefit we'll talk about right now, which is the employer payroll tax deferral. This is a deferral of payroll taxes, only the employer's FICA portion, so it's 6.2% up to the first 137,000 of wages, I believe, per employee from March 27th to the end of the year. And so employers can defer making those payments, and then they will be due by half by the end of 2021, and the other half with the balance by the end of 2022. And so it's an interest-free loan available to any employer, no qualification required, no shutdown required, no declining gross receipts or anything like that. And so that's available as long as there's no forgiveness obtained under a PPP. So the employee retention tax credit is unavailable if you obtain a PPP, but the payroll tax deferral is only unavailable if you obtain forgiveness under a PPP loan. Well, the IRS recently came out with very favorable guidance that said you can apply for the payroll tax deferral now, and you can continue to take that deferral even after you get the PPP loan. And you can continue that deferral all the way up to the point where you get a decision from your lender on the forgiveness application, which you're going to apply for. So really, essentially, that takes you almost to the end of the year. So most people, in all practical purposes, can take advantage of both the employer payroll tax deferral and the PPP loan and get forgiveness. Since even if you got a loan, for example, May 1st, your 8-week period would end at the end of June. Figure it takes 2 to 3 months to file the application for forgiveness, so that takes you to end of September. The lender then has 60 days to render a decision, so that's the end of November. So you know, in the typical case, it's going to be at least until the end of November, maybe end of October, November. So most people will be able to defer the payroll taxes interest-free and take advantage of the PPP and forgiveness. But there's no guidance on the employee retention tax credit, so it's slightly different there. But in reality, that issue will go away probably in about 2 to 3 weeks, right? By then, everyone will have heard about their PPP loan and will be able to then start, if they didn't get it, they'll know they're not getting any more, and they'll be able to take the employee retention tax credit.
Okay. Are you aware of any limitations on the funding for the retention credit out there where the government would say it's done and we're not going to fund it any longer?
No, that's not subject to limitation like the PPP. And that's simply a credit that's available, and you simply you take advantage of it. It's a refundable tax credit, so you reduce your employment taxes to the extent of the expected amount of the credits. And if you have more credits than deposits in your payroll taxes, you can file Form 7200 and get a refund or an advance payment of those taxes within 2 to 3 weeks from the IRS. So it'll come quickly, and the goal is to provide liquidity to businesses.
Okay, so there are plenty of organizations out there struggling, you know, to find ways to get money, especially in the not-for-profit world. Contributions have naturally declined while everybody's concerned and uncertain with what the future holds. Are there any changes or incentives to donors for the tax deductibility of, you know, contributions to not-for-profits?
Yeah, there are two main incentives that were passed as part of the CARES Act. One is a smaller one. It's a $300 above the line charitable contribution for cash contributions made to churches and certain charities. And this is by above the line, it just means doesn't require taxpayers to itemize their tax deductions. Normally, charitable contributions are only available to taxpayers that itemize their tax deductions, but because the standard deduction has been raised so much as part of the Tax Cuts and Jobs Act in 2017, most taxpayers take the standard deduction. So by making this above the line, it's basically saying that if someone who takes the standard deduction, they can now take $300 in cash contributions they can deduct on their 2020 taxes. Second, they've increased the adjustable gross income limit for charitable contributions from 60% to 100%. So at the high end of donations, they've allowed individual taxpayers to make larger donations. There was an increase, not as generous, but an increase in the corporate donation rule as well.
Yeah, thanks, Dan. We have one that's kind of general in nature. Insights on internal controls over ACH payments, including what information are companies collecting from individuals, how are they collecting the information, and how are companies ensuring that it is protected and secure? Are they using secure email portals, fax, or just having people mail in the information? So, you know, what we're seeing, I mean, obviously it's a case-by-case basis. Every organization is different, and every organization has capabilities based on, you know, their funding levels and what they can do. I thought it was nice to hear what Rebecca mentioned earlier about positive pay and the ACH debit blocking. Those are certainly some opportunities that, you know, you could reach out to your bankers without having to implement something necessarily on your side that could help you from a control standpoint. What we are seeing is, you know, naturally organizations getting away from paper, doing things more digitally, and whether that's pay companies that handle AP, or any of those other digital secure portals. We at Withum, when we're doing our audit and our exchange information between clients, we have Box, which is a software platform, that's secure portal. We have various other exchanges. Whenever those are available, you should certainly seek those opportunities to protect information. What we're also seeing is that organizations are trying to collect less information. The less information you're collecting from your donors and your customers naturally reduces your risk, because if some of that information gets out, there's some hefty financial ramifications and credit coverage that hopefully insurance can help you with, but depending on the severity of the situation, could put you in a bad spot, not to mention the bad publicity that would impact future customers and future donors going forward.
It also disincentivizes the use of cash, right? Because people don't want to touch the dollars anymore after other people have touched them. So it's a strange thing. You go to the food store, and I see a lot more people using the Apple Pay, where you just swipe your iPhone over the reader.
All right, so I think we've gotten basically through all the previously submitted questions, and some of the questions that were online we've addressed as well. And so this will kind of be open for whoever feels they can address it. If employees don't want to come back because we don't have PPE to protect them, or PPP to protect them, what can we do in this situation to incentivize them?
Well, there's always hazard pay, but I assume that was obvious, right? That's a tough call, right? I mean, people have the right to safety. On the other hand, they don't have the right to unreasonable demands for safety. So I think it's a case-by-case basis. What's reasonable for the industry you're in? I don't have an answer. It depends on the industry, how close they're required to work with other people. I know at Withum, we're thinking about requiring masks when we open the office back up in June. We're thinking maybe end of May, June would be when the offices open up. They've already ordered masks. Were informed yesterday, and every office now has masks, and they may require masks in the office in an accounting firm. So it's hard to say. That's depends on the business, the industry, that kind of thing.
Yeah, and you mentioned hazard pay. We have some clients in the nursing home industry,
Yeah.
and they were having hard times. I had a client that actually had some of their employees retire rather than come in. And what they did is they had to pay hazard pay. They increased the hourly rate for their employees just to get them to come in, and then make sure they're providing them with all that personal protection, masks, gloves, and things like that. But the big thing was they had to pay more to get people to come in.
Yeah. They deserve it too. There was talk about passing legislation to increase pay, even for the people working at food stores, and they should.
Dan, this one's for you as well. If you receive the PPP loan funding, must you start using those funds as soon as you receive them, or do you have some grace period to initiate spending them?
Well, you have 8 weeks. So from the day you get your money, if you get your money on a Wednesday, that's when it starts the day you first get the money from the SBA, and your lender rather. And if you get the money on Wednesday, let's say, your 8-week period ends on Tuesday, 8 weeks later. And so you must spend the money during that 8 weeks to have any hope of forgiveness. Then the question is what payments are covered. We'll get guidance on that in the near future. We know it's those 4 items: payroll costs, rent, utilities, and interest on mortgages. But what's not clear is which payments are covered, whether payments have to be accrued during the 8-week period or paid or both. We expect there'll be guidance on that. What I've sort of been telling people, like a lot of times people will say, I got my money on a Monday, but my payroll is Wednesday for staff. So what I've said is I would continue to make the payroll. Let's say you pay every 2 weeks. So you have biweekly payroll. I said you'll only end up making 8 payments during the 8-week period. And I think all those 4 payments, will be covered, even though all those 4 payments will be covered, even though the first payment covered 12 days that were preceded the 8-week period. And the last payment, the last 12 days of the period will not be covered because they're included in a payment that's 2 days after, 3 days after the 8-week period ends. But as long as you got 4 weeks of payments in, that covers 8 weeks of payroll I think that'll be acceptable under whatever rules they come out with.
So as long as you're consistent and you have a kind of a flat wage scale, it shouldn't impact you, the carryover and the incurred and paid.
I think that's a practical rule they're going to have to come out with. Otherwise, it doesn't make sense to prorate. Like in that payroll example, it's going to be the same whether you prorate the first and last payment or just take the 8 payments you made. And unless you get into people paying bonuses and that kind of thing. The issue comes up with rent, prepaid rent. I think what they don't want you to do is the last day of your 8-week period, you pay 2 months of rent and to jack up your overhead expenses to include in the forgiveness calculation. So as long as you pay 2 months of rent and, close to the ordinary course when you normally make the payments, I think that's going to be acceptable. And same thing with 2 months utilities. They just don't want you prepaying significant amounts or paying for prior periods that you hadn't paid previously.
Right. So there's an organization who's planning to fill an executive director position that has been open for 13 months. The new director will start June 1st. They have not had any cut in staff salaries or staff numbers, so their FTE and wage test forgiveness should be fine. Can they use those loan proceeds to pay for that new employee, despite them not being around when all the application and
yes, the answer is yes. They definitely can, subject to they're going to meet the headcount rules. We mentioned this is a rehire situation. They're going to meet the headcount rule. The question is the SBA going to be punitive and apply the wage reduction rule? Because the employee that justified the wages is no longer with the firm, right? And that justified the way it was paid in 2019, and so their wages went to zero. And the new person, so the rule gives a reduction for the old person, but not for no increase for the new person. So they're subject to working out that kink, which I believe they will work out favorably. Yes, you can pay the new person.
Sure. Will there be a prepayment penalty if you make the prepayment of 25% of the loan ahead of time?
What do you mean?
Be subject to any prepayment penalty? I'm
no.
assuming they determine they're not going to use the funds and they just want to give them back.
Yes, no prepayment penalty. You can prepay without penalty. And it makes sense to give it back if you're worried about using it and not being able to pay it back. We expect, by the way, that most people will not get 100% forgiveness. There's going to be the rare taxpayer that gets 100% forgiveness. So people, it really behooves them to consider a separate account so they don't spend the money and end up with a repayment obligation at the end that they are unable to make. So we're encouraging, separate accounts and close tracking of the money.
That's not a requirement, Dan, right? That's a best practice.
Correct.
So here's a good one I don't think we've addressed. Is there any guidance on the PPP and forgiveness expected for businesses that are unable to reopen even after the 8-week period? As a not-for-profit organization, we may not be able to open until the end of the year, and so our layoffs and reductions will continue. Do you think there will be any modification of the forgiveness in circumstances like this?
So there's no guidance on that. The program as written and as interpreted by the SBA intends you to bring the people back and pay them, even if you're going to let them go in 8 weeks. That maybe they expand it, maybe they don't, who knows? But that's what they're contemplating, and there's no requirement that you have the money to keep them employed after that 8-week period.
So in a scenario where you apply for the funding based on pre-COVID numbers and you've been shut down, would the suggestion be then to just continue paying your employees as they're at home? Otherwise, you're going to get hit, with the forgiveness issues on those employees, right?
Right. So we've seen some employers say, look, some of my employees are working and others are staying home, and I feel uncomfortable paying everyone the same. And they view it as a moral issue. And without getting into that, this is what we've been telling clients and people who ask is this is not a exercise in determining who should be paid the most. You have to view this as not your money; it's the government's money. And if you spend it the way they want you to spend it, you won't have to repay it. And so those kinds of things, they want you to pay people to stay home. And that's what the money, even if they're staying home, they want you to continue paying them. And they will forgive that to the extent you pay them. The calculations can be somewhat harsh. So we really do stress people run some calculations either on their own or have their advisor help them. But if you don't bring back your staff or you reduce wages, the reductions can be pretty harsh, and the employer can be stuck having paid wages that they're unable to get forgiveness for. Now they have to come out of pocket to repay the loan. And I think that will be a big surprise for people, which is why we're cautioning everybody to run the calcs as you expect them, do a couple, what if scenarios. And, we're set up to do that. I'm sure many other accounting firms are as well. But don't get caught at the last minute having paid your employees, not getting forgiveness is what you expected. Now you need to come up with additional money to repay the loan.
Yeah. So, just as kind of a housekeeping concept, we have about 6 to 7 minutes left, and we have a lot of questions pouring in. We'll continue to address them over the next 7 minutes as they've come in. And for those that, we can't get to, we'll certainly try to reach out individually after the fact to address your concerns. All right, because it was not yet clear that federal salaries would be deemed double dipping, we included those amounts in our request for the loan. Now it seems that when we do our calculations, the amount of federal salaries will cause us to have less than 75% of our expenses for salaries because we now must exclude them from forgiveness. Can we refund a portion of the loan related to the federal salaries so that the payroll cost will be over 75% of the reduced loan amount? So I think
that's a good question. There's no guidance on the well, you're limited in forgiveness by the total amount of the loan, but that's not going to be the person's limitation here. The limiting factor will be the wages they pay. And so even if you borrow, for example, you borrow 100,000 and you only pay wages of 30,000, I think the way it's going to work, you're going to pay 30,000, and then you're going to have significant reductions on the calculation, which reduce you to zero. And so I think the way in that scenario, I think this is why you need to model it out. Even if you spend 30,000 on wages, the government kind of expected 75. The way the calculations are going to work, it's going to reduce your forgiveness amount by 30. So you paid 30, you reduce it by 30, you're down to zero, which means you owe the government all of their money back, even though you paid wages. And that's the kind of scenario we're cautioning people to beware of, because you might end up paying your employees with the government money, not getting forgiveness, and then having to come out of pocket to repay the government.
So Dan, let me frame it a little differently. So in the upfront loan application period, they have 100,000 of employees. We'll say 50,000 is government funded, 50,000 is other salaries. So they got a $100,000 loan. As they're moving through it, they're here now, and they're not going to pay those 50,000 because they don't want to double dip. So they pay the other group the 50,000. Can they not just give back that 50,000? At the end of the day, the wages from a employee by employee standpoint would still be comparable. So there wouldn't be a wage reduction unless it's looked at from the use of loan proceeds to pay wages.
Well, there is some talk about using the employees in the application. And if they do that, they're going to have a major reduction in FTEs, right? That's my concern, is that even though they're paying back half the wages, nothing says they get to reduce the headcount by those people, right? And so I think they're trying to do the right thing, and I think that person, it's admirable what they're trying to do. I just think that the calculations don't allow for that. And a strict mechanical calculation of the headcount reduction and the wage reduction will probably mean that person has zero forgiveness, right?
Okay.
I understand what they're trying to do, and it's a practical approach to a problem. I just think again, I'm not advising them here on the call, but I really think they need to struggle with and go through the forgiveness calculations to make sure they're comfortable that they're going to get forgiveness on the 25 or 50 remaining, right?
Yeah.
So presumably that would be something like 38 payroll, 12 of or 12.5 of overhead, right? 25-75 ratio.
Yeah. We've heard from our bank that we were approved. How long does it take to get the money? What are we seeing from our clients of approval? And I know it depends on which approval we're talking about. Is it the bank approving you that you got the documents in, or the SBA approval?
So for when the bank approves you, it's an unknown. Some are taking 2 days, some are taking 3 weeks. And when they submit you to the SBA, that's somewhat of an unknown. What I can tell you for sure is from when you get this, when you sign the loan document, it takes 1 to 3 days to get funded from that point. So after you get approved by the SBA, your lender will give you a loan document anywhere from 3 to 5 pages. Some are producing certification pages as well. And then you sign that, give that to your bank, and then you'll have funding within 1 to 3 days.
Technically, when does the 8-week forgiveness period technically start? It doesn't align with actual pay dates, but it's the day of funding, correct?
But the first day you get money from the bank.
For the $300 above the line contribution deduction, I'm assuming they're referencing, is it a 1-for-1 deduction or is it phased in? Do we know that?
I believe it's dollar for dollar. Yeah, I think it is, yeah. It's above the line, so there's nothing to phase it. So yeah. I believe it's dollar for dollar.
What would you recommend in terms of proceeding with the employee retention tax credit when the office is located in one state, yet most employees live in a neighboring state that has different government orders in terms of shutdowns? Would it be appropriate to utilize both states' orders in determining eligibility for taking the credit?
Yeah, so the rule's not keyed off of any particular state. It says if any government shutdown is affecting your business, you get the credit. And there's a separate rule if you're more than 100 employees or less than 100. If you're more than 100 employees, it's only the wages of people who are not working. And if you're under 100, it's all your employees. So if you're in 2 states, let's say, and one of them has a shutdown restriction that's affecting your business, you're entitled to the credit at that point because you're not operating at normal capacity. And if you're under 100, it applies to all employees. If you're over 100, it's only those that are not working. So it would be only that state, the employees in that state who are not working as a result of the shutdown. So you get very different results based on the size of the company or at not-for-profit.
This will be our last question. Can a 501c3 rely on the alternative business concern if they meet both the income and the net worth test?
I haven't seen anything that limits them to that. So I don't know offhand, but I know there are the 3 tests. I haven't seen anything limiting that third net worth test, tangible net worth, to business concerns as opposed to not-for-profits. So I don't know offhand, but I don't recall anything limiting application of that test. It's in that test comes from, by the way, it's in the IFR 2. So that SBA document, interim final rule number 2, was issued around April 14th. That's where it's laid out, this that rule, and made obviously applicable, I guess is a better way to say it. So maybe it was probably in there.
Okay, I mean, I think one more just popped up, and I think it's an easy answer. It kind of relates to the Families First Act. We are an essential company. Can an employee request a leave for child care leave because the school is closed, refuse to work, and apply for unemployment because they would get more money? Now, I don't think they could get leave and paid leave and unemployment, right?
You can't get both. Yeah. If they're still employed, they have the right to get the sick and family leave, and the employer must give it to them, and the employer gets reimbursed by the federal government. Once that's happening, they're ineligible for unemployment. So if they quit, they don't get unemployment because it's a voluntary situation, right? You can't voluntarily be unemployed and get unemployment. You have to be let go or laid off, that kind of thing. And if you're fired for cause, you don't get it either. So they don't have a choice in the matter. If they quit, they don't get unemployment. And if they stay and get the sick pay, they don't get unemployment. So I think either way, it's not really their choice, is the way I'd answer the question.
So this question, actually, I got a similar, somewhat related question from a client yesterday concerning, we're in the summer months and summer school or summer camps are right around the corner. And the question was whether, this would apply, this Families for the Leave Act, under the conditions of the school closing if schools end traditionally on June 1st. And correct me if I'm wrong, the guidance says daycare or any childcare, and it goes on to even say summer camps that would traditionally be available. Is that your understanding?
Sorry, we have a call that's coming in right now and they're chasing me down. The question was about summer camp and whether
the inability to put a child in summer camp or summer school or a summer program after the traditional school season ends would allow the individual employee to qualify for the Leave Act, the Families First Leave Act.
I don't know about summer camp. The condition talks about there's the 3 requirements of the Family Leave Act. Talk about caring for someone else. I forget, was it tied to school? I just don't recall offhand. Let me see, I can probably get a quick answer. I just forget how they phrased it, whether the child had to be unable to get childcare because of school as opposed to summer camp. Let me see if I can get a quick answer to that for you. I just got to read the condition, which is they have a bona fide need to care for an individual who's quarantined. That's not it. And this is the relevant one. The caring for a child, under age 18 whose school or place of care has been closed, or for son or daughter whose care is unavailable. So yeah, that would seem to cover it, right? Because their place of care is the camp, and that's closed.
All right. Well, thanks, Dan. Thanks, Jim. Thanks, Rebecca, Jordan, and Travis. We appreciate the time today, and hopefully this was valuable for all the attendees.
Thank you. One last point too. I think the Department of Labor has guidance out, frequently asked questions that may address that last question and be more specific than the answer I gave about the school and the camp. So I would check that site, and there's probably something there on that.
And again, if we by chance overlooked the question or didn't address it specifically, we'll do our best to address those individually with the individual who put it in. Again, from all the sponsors, thank you for taking the time. We hope this crisis ends soon and everybody can get back to work. And certainly, we're here to help if anybody has any issues or questions that we can assist with.
Thank you.
Great. Thanks everybody for tuning in. Thanks to the panelists. Please remember to take a moment just to complete the online